What's going on, guys? My name is Richard, and welcome back to the Stock Market Outlook video. Last week was definitely a tough one in the market. My personal account, I know, went from all-time highs to pulling back considerably, but thankfully still positive for September. And probably since we trade a lot of the same stocks, a lot of you watching this probably experienced the exact same thing. So before we get into the usual analysis of the indexes, market leaders, the past watch lists, as well as sentiment surveys, the IBD big picture, as well as the Wishing Well blog, I want to kind of go through my personal process last week, what I was thinking psychologically, and what I was doing actually in my account. So if we go to a daily chart on the QQQ, I'll kind of talk through exactly what I was thinking on each of the days this week. So overall, on this past Monday, we were approaching this upper channel line, so I was getting a little bit more cautious. I wasn't taking new buys, and I was looking instead to add to positions that were showing a lot of relative strength. And overall, we bounced off this and moved downward somewhat. But then on this Tuesday, we had a very strong day, a gap up, and then a close right near the upper end of the trading range. So a very bullish day. But once again, I was being a little bit more conservative. I did actually try Fiverr on this day as it broke the downward trend line. Actually, I bought that on Monday and added a little bit up here. But eventually, I was stopped out on this day on this huge drop in the first 15 minutes. Anyway, getting back to the focus of this video. So on this day, we had a quick move down in a lot of growth stocks, and I basically cut all new buys and also kind of cut everything that I didn't have a large gain in. And the reason I do this is because those are the stocks that are more risky because I'm giving back actual capital instead of profits. So psychologically, it's a lot easier for me to hold through a pullback if I have a 30, 40, even 50% gain in the position. So on this day, I cut stocks like TTD that I just bought the few days before. And we did have a very strong rally actually towards the end of this day. And that was after I cut all my positions, unfortunately. But it happens. You have to follow what's going on in the moment. And at the time that I cut those and made the decision to cut those, we were falling very, very quickly. And so at the end of this day, I actually started some SQQQ to hedge against my long positions that I had remaining. And at this time, I was holding stocks like CrowdStrike, which I bought back down here. So about a 35% position, or 30, 45% gain rather, and also Coupa Software, and also Zoom. So all of these I was up considerably because I bought them kind of near the bottom of the base before the double bottom pivot right here. So I was feeling good with the positions I had with their profit margins, and I wanted to sit through that by hedging with some SQQQ. Unfortunately, I had drawn lines in the sand, and Crowd hit mine on that Thursday, and also Coupa Software hit that as well. And on this day, I not only knocked out the new buys, but I also minimized positions in CrowdStrike and also Coop. So I kind of had my line in the sand, and I blew out those positions on Thursday for both CrowdStrike and Coop. And the only stocks I had going into this Friday was actually Zoom, and that was a 1/3 position. And I had my line in the sand down at 360. And I got my stop hit, and I'm stopped out of that currently. And I'm not really disappointed in that, especially even given that it kind of gained past my sell point. And that's because I followed my rules. I had my line in the sand, and I was protecting my capital at all costs. And this year, thankfully, has been very good for growth style swing traders, position traders. So I wasn't prepared to give back too many profits, and my count was at all-time highs earlier in the week, but I gave back a considerable amount, 5-7%, and I didn't want to lose any more of those gains. So I think, once again, the number one rule in being successful over time in the stock market is not giving up a lot of those profits and making sure you don't have any huge losses, and that's what risk management is all about. So hopefully that kind of gives you some insight into how I was viewing last week. And one last thing that I forgot to mention. So on this past Friday, we had this nice recovery right to the 21 EMA and back above this lower channel line. So on that day, if we go intraday on a 15 minutes, I actually sold out my SQQQ position on the first green dot on a 15-minute chart, which was also a Bollinger Band bounce, lower Bollinger Band bounce, for a nice 15-16% gain. So my hedging did successfully protect my long positions, and overall, I think I handled this week relatively well. And right now, I'm sitting completely in cash, but definitely looking for new setups, looking for stocks that are showing relative strength. And I'll probably make a video later on this weekend, kind of highlighting a few of the stocks that I've been watching personally. So hopefully that gives you a sense of how I was playing last week and a sense of kind of my risk management system. And with that, let's get into the usual analysis of the market indexes. And let's start off on a weekly time frame with the QQQ. So overall, we were down on the week, down 3%. But as we saw that big push last Friday, we recovered quite a bit. And overall, from this bar, we are in the lower half. So the expectation is we go sideways or down, especially considering this high volume day or high volume week that we had. And overall, the weekly closing range was 37.2%. The daily closing range on Friday was 68.8%. And we are still in a clear stage 2 uptrend if we go to this chart right here above the 10-week and rising 30-week moving averages. And going over to the SPY, let's take a look at the S&P 500. On the week, we were down 2.28%, a weekly closing range of 32.2%, and a daily closing range on this past Friday of 59.4%. And overall, as with the QQQ, we are still above a rising 10-week moving average and also above a rising 30-week moving average. So at this time, we are still in a stage 2 uptrend. And lastly, taking a look at the Russell 2000, the IWM, you can see that we're also down 2.75%, a weekly closing range of 36.2%, and a daily closing range of 53.2%. And at this time, we are not in a stage 2 uptrend because the 30-week is decreasing, but we're in this nice kind of consolidation, this longer term base. So I think if this recovers and takes out these highs, that would be very bullish. And I do want to see this start a new stage 2 uptrend because it still hasn't fully recovered from the quick crash in March and February. So those are the main indexes that I look at. And moving on, let's also check out the Dow Jones, which also is down on the week, down 1.72% with a weekly closing range of 31%, a daily closing range of 54.2%. And moving on, we've got, let's take a look at gold. And overall, it's consolidating in this short-term pullback to the 10-week moving average. And overall, it was down 1.49%, a weekly closing range of 22.9%, and a daily closing range of 77.6%. So from this bar, the expectation is we go sideways or lower. And I forgot to actually do that for the SPY. So once again, the expectation is we go sideways or lower. And also for the IWM, it's the same. So moving on, we've also got the VIX, and this is definitely a sign that volatility is coming back into the market, which is a negative for my style of trading. And overall, we are up 33.93% with a weekly closing range of 54.4% and a daily closing range of 14% on this past Friday. And lastly, taking a look at, or actually not lastly, but taking a look at the XLF, you can see we were barely down on the week, down 0.28%, a weekly closing range of 37.9%, and a daily closing range on Friday of 50%. And at this time, this is in a stage 1 because it's above a declining 30-week moving average. And lastly, taking a look at growth stocks, the FFTY, the Innovator IBD 50 ETF. Overall, this really reflects how growth stocks have been performing. You see a big down bar this week, down 4%, a weekly closing range of 33.9%, and a daily closing range of 66%. So from this bar, the expectation is we go sideways or down, and really looking at the charts of a bunch of growth stocks, that's their expectation as well. But so far, we are holding that 10-week moving average, and at this time, we are above a increasing 30-week moving average. So it just started a stage 2 uptrend, but it really has to keep moving up for that to stay the case. So those were the major ETFs on a weekly time frame, and we already covered the day-by-day analysis on the QQQ, but I do want to talk about these channel lines and the also potential support at the 50-day moving average and these prior resistance levels. So overall, we had a quick move up on Wednesday, as we already talked about, and once again, this is a reason for me to be cautious. We are well extended from this channel and near the top of the Bollinger Bands. And then on this Thursday, we had a quick drop down 5%. And then on Friday, we had a really fast move down close to the 50-day I did post on Twitter that this was kind of a level I was watching for potential support because it was near the 50-day moving average, as well as the top of this downside reversal on 7/13. So we rebounded very sharply from that bottom and recovered to inside the channel and also very close to the 21 EMA. Let's see, we were just a hair below it. So next week, I really want to see us stay within this channel. And if we move down from here, I think that would be a sign that we're due for some more choppiness in the market and potentially some sideways action, which would be very constructive. I do not believe that we will have a big crash like we already saw this year. Instead, I think this is a normal bull market correction where we set things up, the leaders will build new bases, and will continue the uptrend once we recover from that sideways action. So those are the ETFs, and I also want to cover the 50-day check, which is kind of the extension from the 50-day moving average on the QQQ. And once again, this is one of the kind of yellow flags that I was watching this past week, and we peaked on Wednesday. And looking at it, you can see we were at 15%, which is historically very, very high and very extended. And we were approaching the highs that we had earlier, which I think is a negative because at this time we were moving up so quickly, and to accelerate again and get to those levels was a little bit too far, too fast. And also we'll talk about the Webby RSI because I mentioned this in my previous video. If we go to the NASDAQ composite, you can see we were approaching that caution sign above 4% before this crash, or not crash, but quick move down. So once again, this was getting overheated last week, and another reason to be cautious. And it was something that I was looking at when I determined I should put on a hedge. So that is kind of what I want to talk about in terms of the indexes. And now let's move on to those true market leaders. And overall, all of them were down pretty much for the week, except for Zoom and CrowdStrike. Zoom really had a very strong earnings report. And let's hide these lines right here. Moved up almost, over 40%, but then started filling that gap late last week, although it did show some signs on this Friday that could be reversing and potentially starting a move up once again. And overall, in terms of the market leaders, the ones that I am watching most closely are Tesla, which really showed relative strength on Friday, although it did move down after hours after it wasn't accepted into the S&P 500. And I am watching Tesla very closely because I think it is a leader among these leaders. And if it loses this 21 EMA, I think we're definitely due for some sideways action within this market. But overall, let's go through these very quickly. So Zoom doing nothing wrong, but pulling back into this gap right here. You want to see it hold this 21 EMA. CrowdStrike as well had some nice reversal action on this Friday and held that 21 EMA. Moving on, we've got DocuSign, which bounced off its 50-day last week. And Vive also held that 50-day. Okta is now below that, which is a potential red flag, although it's still above this prior low. Amazon as well found support at the 50-day moving average. AMD is looking relatively strong. It didn't even go down to its 50-day and is pretty much holding within this low right here. Fiverr as well is showing a little bit of relative strength, and this will be one that I'm watching next week. NVIDIA also is showing some strength, although it did move down quite substantially after a downside reversal on Wednesday, but it is holding that 21 EMA, and it was on higher volume, that reversal. LVGO held its 50-day. DDOG is still below that 50-day moving average. You can see the 21 EMA is actually decreasing, so I would not be touching this at this time. It could potentially be forming a double bottom if it undercuts this low right here. Apple, you can see, also showed something this past Friday as it held the 21 EMA on higher volume. ZS held at 50-day. Inficorp is living below its 50-day now, so I wouldn't be touching this. It looks like it's forming the left side of a potential base. TDOC as well is living below its 50-day moving average. Tesla, we already talked about. SC is looking pretty strong. It didn't even approach its 50-day moving average and is potentially a lower Bollinger Band bounce early next week. Shopify as well is below its 50-day, although it did have some nice reversal action on this Friday. Chegg below its 50-day. TTD below its 50-day. SCDG had a nice bounce off the 50-day moving average. And Twilio is below its 50-day. Fastly below its 50-day. And Coop below its 50-day as well. And EMPH a nice bounce off the 50-day. So I think it's important to realize that even the ones that bounce off the 50-day moving average, there was a lot of damage done. And this is such a quick move down that's going to take some time to absorb this selling, and we will most likely see some sideways action before it recovers and potentially approaches new all-time highs. So I think, at least personally, I'm going to be very selective in terms of the stocks that I start next week, and I will be entering with smaller positions than normal. So those are the leaders, and now let's take a look at my previous watch list. And overall, sorting by the weekly change, this is my universe list. You can see that the best performer last week was Tupperware, which is not a good sign for growth stocks because Tupperware is leading up almost 40% on the week. REGI also did very well, and this will be one that I'm watching early next week. It really showed a lot of relative strength this past week, moving up actually almost 4% on Friday. API as well was doing pretty well, and could be forming a little cup and handle at this moment. CrowdStrike, we already talked about. And going to my actual watch list, we'll sort by the weekly change. So overall, all of them lost money last week, which isn't surprising given the overall market conditions. TSM is holding up pretty well actually within this kind of sideways consolidation. UPS is also holding up pretty well. So pay attention to these stocks that haven't really broken their charts. And in my view, TSM, you wouldn't really have known that there was a huge pullback in growth stocks looking at just this chart. So pay attention to stocks that look like this. But moving on, we've got HDNP, which had a nice reversal right near the 50-day moving average. Apps as well is holding in there, holding that 21 EMA. AMD as well doesn't look too bad. Fiverr as well, I said I started on this day and added on this day, but got stopped out in here. But this will be one that I'm watching because, once again, its daily chart doesn't look too broken. If we go to a weekly, it just looks like normal consolidation. So always take a look at the weeklies and make sure that that looks good as well. TTWO, you can see it bounce off the 50-day moving average. XP is holding that 21 EMA. Big C had a nice upside reversal on Friday, so make sure you're watching that into earnings. SCDG, we already covered. MPH, we already covered. And PRTS really broke down last week, and I would not be touching this stock. So overall, given the market weakness, I'm not surprised that we actually didn't have any positive stocks this week, but I will be giving you guys my best setups that I'm watching tomorrow when I post my next weekly watch list. So moving on, let's go on over to the sentiment surveys that I post on Twitter. And overall, it doesn't seem like a lot of fear came into the market, at least from these surveys, because last week we were at 47.6% bullish, and this week is identical, which I actually was surprised about. But take that into account, we might need another quick flush down to really get people to be more bearish. And also going to the put call ratio, you can see that this does show that there's a little bit of fear coming into the market. It's moving the right direction, although it's not quite at this one level, which I'm watching, and also 1.15. And moving on to the bulls versus bears, this is above 60%, which is a negative. You want this to start moving back down. And overall, this indicates that there's still a lot of people who are very, very bullish. But taking a look at the NAAIM index, you can see that the latest reading is 94.71, which is a nice move down from 106.56, but it's still somewhat elevated, so keep that in mind. We could see another quick flush down early next week, and in my view, that would be a positive in the long run. So moving on, let's go to the IBD Big Picture article, and overall their headline is the stock market rally teeters, but NASDAQ bounces bullishly off the 50-day line. And overall, they discuss how on Friday the price action was a win for the bulls after pairing about a 5.1% loss in the morning all the way back to 1.3%. And they also talk about the other indexes and their action, but they also discuss how there wasn't much fear in the stock market, and the outlook was in question given that the NASDAQ was breaking sharply below its 21 EMA, but the NASDAQ did close strongly as we saw. And they move on to talk about a couple of the stocks in the IBD 50 and how they were down 6%, 11.5%. So there definitely were a lot of those stocks getting hit very, very hard Thursday and Friday. And they talk about Tesla, Apple, and Amazon, which are some leaders to focus on to kind of get a sense of whether we will be going sideways or actually recover strongly from this pullback. And they also discuss how some key stocks, Dexcom, Twilio, Coop, Etsy, flash sell signals with decisive closes below their 10-week lines, which is very important to keep in mind. So overall, their view is we are still in a confirmed uptrend, and we now have 3 distribution days on the S&P 500 and 2 on the NASDAQ. So still relatively low numbers, but I think that the action of the leading stocks and also the stocks in your own personal portfolio is much more important than these numbers right here. So moving on, let's take a look at the GMI signal, which is still green since April 27th, and the GMI score is a 4 out of 6 on this past Thursday. So overall, taking everything into account, my current view is we are in an uptrend under pressure, and I really need to see Tesla, Amazon, Apple hold those key moving averages, the 21 EMA, and the other growth stock leaders hold their 50-day moving averages. Otherwise, I think we're going to have some more sideways action and chop, which isn't good for my personal style. So make sure you guys are managing your risk and trading only when you see an edge. And I think it's best to be careful at this time until we get a decisive move up and see some accumulation in those leaders. So thank you guys so much for watching. Please remember to leave a like down below and subscribe if you're new to the channel. And best of luck next week. And I'll see you guys in future videos.